This is Eat, Sleep, Invest, the marketing podcast for real estate investors to get more deals. Hey, welcome back, everyone, to another episode of Eat, Sleep, and Invest. I'm your host, Brian Driscoll, and I'm here with Eddie Speed. What's going on, Eddie?
How are you?
I can't complain. How you doing?
I'm doing great.
Yeah, great. It's great having you here. So I know you have a lot of experience with buying notes and also like creative financing, stuff like that. Why don't you give everyone a little background on what all you do?
So I started out kind of different than most people that are in the industry, right? I actually started out as a note buyer. And I started out a long time ago in 1980. And so then, by the late 80s, I started working with real estate investors because they wanted to create seller financing and they didn't know how to do it, right? And so I really, my first big recognizable customer was homevestors. I set up the note system for homevestors around 1990 or 1991. And at one time, 60% of every homevestor transaction was a seller finance note.
Really?
Yep. And so I have bought 50,000 notes, but 40,000 of those notes are where I gave somebody a way to manufacture the note. In other words, I gave them a recipe. And so that's really, I've taken that concept and I've taken it to now, like, okay, how do I go buy on creative terms? Because apparently the banks don't want to loan cheap money anymore. Right? And what I've learned is how I've learned creative financing is different than anybody else that says they do it. And you say, well, how could that be? You know anybody else that's looked at 200,000 or 300,000 seller finance notes?
I do not.
So I started understanding the note business from somebody that carried a note. Now, not the professional real estate investor that's already probably followed a formula that started with me, right? But like somebody else that did seller financing, just a mom and pop. And I would see them agree to like crazy stuff that didn't make any sense, but it made sense to them. And so I started understanding how the seller who carried owner financing, who didn't understand very much about finance, I started understanding how they thought. Think of it like this. A 7th grade English teacher doesn't think like a 7th grader. But a 7th grade English teacher knows how a 7th grader thinks. Yeah. And so that led me to why I went in the direction that I went. Like, why did I do this? And that really changed everything.
Yeah, so that's interesting too, because a lot of people, I think, don't think about how the seller's thinking. They're thinking on, okay, here's what I need to do to make a deal think versus what the seller's actually thinking in their head and what makes sense to solve their problems.
One of the things that I've learned is people are in a real estate negotiation that involves financing, right? Now, a lot of the modern day house flippers, let's be honest about it, they are not super good at understanding any form of financial modeling. So I've learned that I have to teach that to them. They're very smart. They're very teachable. They just were in a buy low, sell high business, and that just wasn't part of what they had to learn. I've spent my whole life having to learn financial modeling. Now, you can say, well, that intimidates me. Okay, you also can make a lot of money doing it. Is it worth slowing down and figuring it out? And the other thing is so much of what I've developed now are just templates. You don't have to go be a calculator whiz at doing it. I've got spreadsheets that you just plug in certain numbers and it calculates the rest of it. Right? So you don't, and then I'm teaching people what you're negotiating for. Let me give you a great example. Okay? Sellers to carry long-term financing. If seller is going to owner finance you over a long period of time, they're probably going to want interest. Now, I know every guru in the world, including me, has those case studies where they carried a 20 or 30-year note at 0%. Everybody has that case study. But the deal is, I know statistically that about 14% of the time they'll carry 0%, and about 86% of the time they won't. In other words, they may carry 0% for 5 years, but that's not going to do you any good, right? That's just a bridge loan. That's not long-term strategy. So here's an example. How do you lower the effective interest rate you're having to pay, and the seller is totally okay with it? You do an adjustable rate mortgage.
Okay.
Now you specify what the rate is up front. It doesn't adjust to some index. It adjusts to a rate you've already defined. Because, Brian, if you were going to get 1% interest on the full amount financed, let's say you finance $200,000. I could pay you 1% on $200,000, and by the time the rate jumped to 2%, I'm paying that on $150,000. By the time the rate jumped to 4%, I'm paying that only on $100,000. By the time the rate jumped to 6%, it's only on $50,000.
That makes sense.
You see, the seller then is thinking, well, I'm carrying an average of about 3% interest. And that is true. It's an average of 3%, but the effective rate is way less than 2%. You see,
right?
That's why I want people to, like, when people start with me, I'm like, just follow the template I've already tried 10,000 times, right? Because I already know what the math is, and I already know it's good for you, right? The student goes, well, I don't know how to go learn all that. You don't need to learn it. You're just renting me. I've already learned it. You know, if I went to the doctor and found out I had some terrible medical condition, you know, I think I'm kind of renting the doctor's experience and advice on how we're going to deal with this, right? Right? And so the more I go, the more I may learn, but it lets me start from day one with some strategies that I've already tested, because I've already helped people create more creative financing than anybody in the United States. I'm 100% certain about that. Right?
What made you get into this?
It was 1980. My father-in-law was an old real estate investor, and he and another guy pioneered the seller finance note buying business. Interest rates were double digit. People had to seller finance. So there was all this seller financing that was created. And then all of a sudden they wake up one day and they'd want to go sell their payment, sell their note. And that's what got me in it. And then what really changed the business for me is when I really figured out, like, how to go show real estate investors creative financing and give them, you know, a template, a structure, you know, a blueprint. And then once you could do that, then they could go do it over and over and over. And so the first guy that I did it with at a large scale was the guy that founded Home Investors, Ken D'Angelo. I bought notes from he and his brother back in the 80s. So when he decided to franchise Home Investors, he called me up and he says, I want you to be my note guy. He says, every time I create owner finance notes, or one of my franchisees creates owner finance notes, they go to sell it and somebody discounts it more than we thought. And I said, yeah, that's because you cooked the pie the wrong way. You put salt in there instead of sugar. You just didn't know what you were doing. So I went through a long process of learning, like giving people a template. One of the things that's so critical, Brian, about this business, seller financing kind of gets a bad reputation because what you see, people go into a bad area, a blighted area, or they have a property that's terrible, right? And they think, well, that's what seller financing is. It's for bad properties in bad areas and people with terrible credit. That's who gets seller finance. And that's really not a truth at all. Like, the average property that I coach a student to buy today It's 300 grand. The average person that they turn around and sell it on a wrap note to, they buy it on creative terms, and they pay the seller out over time. It's not what you pay, it's how you pay it. Is that true? It's not the price you pay, it's how you're going to pay them back. And then obviously, because of the market we're in, one of the great strategies people like is I'm going to sit around and sell it on a wrap note. I'm going to owner finance somebody else. And you're saying, okay, well, why don't they just get a conventional mortgage? So let me give you a scale for a second. The Mortgage Bankers Association has a scale that they rate the availability of credit. Not what money costs, but who can get the money, right? And they call it a Mortgage Credibility Index or Availability Index, Mortgage Availability Index. Before the virus, it was at 185. Today, it is at 100. So, Eddie, are you saying that almost half of the people that could get a mortgage before the virus can't get one today? Yep.
What, they're just being more strict on their underwriting guidelines and everything now?
It's exactly what it is. Now, so people think that one of the reasons that the mortgage, industry is in this blight that it's in is because of rates. And that is true. Rates have more than doubled in a year, right? When you look at the best mortgage rate today, or you go Google it, you realize that probably only less than 20% of the people, the best 20% of the people get that rate. And everybody else gets what? A higher rate. Exactly. So rates at the point they're at right now, even if you made all the income in the world and you could qualify for that much higher mortgage interest, the mortgage availability says, nope, we're not making a loan to you today. And so what that's left is what your audience should see as the biggest opportunity to do creative financing they've ever seen in their career.
Now, what are some of the reasons sellers agree to owner financing?
Number one, it's very simple. It's price.
They can get more doing the owner finance versus selling on the market.
You hadn't had anybody in the last couple of weeks that really wasn't going to take your price, have you?
Oh, yeah. It's been like that for, this whole year?
Okay. They're stuck on yesterday's Wall Street Journal price.
Mm-hmm.
And you and I know that we got a market that's on the slide and it isn't sliding the right way, right? And so understand that most real estate investors say, I'm going to have 20 candidates that I'm going to make an offer on their property, and one of them probably is going to take it, and 19 of them are not going to take it. Well, why don't you identify the people that could seller finance? There is a filter process that we teach. Who could seller finance? Right? And then once you identify that, then you make a creative offer. And by the way, Brian, a lot of real estate investors really don't know this, but probably 75% of seller financing that will be done in the next few years will be actually a second lien. It won't be a first. Seller's not carrying all of their equity. I don't mean that never happens. I just mean that more oftentimes than not, that there's other money put with the deal to make it work. So the seller carries soft terms, not for all of the price of the property, but for part of the price of the property.
Why is that? Because are you saying because they already have a first mortgage?
Just because they have a wolf at their door. They need some money now. Or they can't, that's one of the things that people really have to understand is the way that you make creative financing work is you got to go look at the customer's problem and then say, how can I fix their problem? And I've developed a very simple process to go do that. It's what you would call an in-out sheet, right? You do it on every flip you do. What does it take to buy the property, and what can I exit it for? You do that on every deal you do, right? There's really no other way to run a business in buying houses. You got to go figure out what you can sell it for before you can figure out what you can buy it for. So I do the exact same thing, but I also, include financing. Maybe you're going to do a sub 2. Maybe you're going to take the existing loan. Maybe they owe 50% of the value of the property, and it's in a low interest rate loan that you could take over. Maybe they do need some cash up front. Maybe they do have an immediate cash need. That's totally legit. You got what I'm saying? So they may, you might get them to carry part of the financing, but not all of the financing. The smaller the amount of financing they carry, the softer the terms I'm going to want.
So you're saying they may need something up front. You find this person, they need 10 grand to move and do whatever. You give them a little bit up front, finance the rest, solve their problem. You just have to find out and uncover by asking the right questions.
Sometimes seller financing is only 10% of the price of the property. Sometimes seller financing is 100% of the price of the property. So what we did is we developed decision tree paths, right? We developed a system that identifies how to go look at the numbers in their deal, very similar to wholesaling. And then once you see that, they might could carry 40% seller financing. They might could carry 80% seller financing. They might could only carry 10% seller financing. Once you figure that out, then I've developed, kind of templates. You can adjust them if you want to, but I've developed templates as if they're carrying this kind of seller financing, structure it like this. These are the 6 most likely things that they're willing to do for you that would really be advantageous for you to do that. Now all of a sudden you wake up and people go, wait a minute, he's making seller financing not sound so hard anymore. That's the goal.
Yeah, because it is a little bit of a gray area too. It's like people don't know what to do. So you're saying you have a system that you take all the details on what you've uncovered from the seller, motivation, equity, things like that. You plug it in, and it can kind of give you a couple options how to structure the deal and make the offer to the person for a seller.
I mean, it's a recipe, right?
Yeah.
And by the way, my friend Ken D'Angelo, he's been sadly passed away 20 years ago now, but a lot of the things that real estate investors do today, a lot of the systems, a lot of the process, that book that's behind you, I'll guarantee you he pioneered a lot of those ideas. Because what he did was put house buying in a can. He had to franchise it.
Right.
Well, people say, well, I had nothing to do with home investors. You may not have, but I'll bet you 2 people back from where you learned it from, I'll guarantee you they copied some things that Ken D'Angelo did. He was a true pioneer in figuring this out. And I got to hang out with him. So he taught me how to do that for the seller finance side. Like how to go mechanize it to where people could just follow a blueprint. And I love being creative, and I get to coach some of the most advanced real estate investors in the country. But the truth of the matter is, if I do that, guess what? He's got an acquisition team, and they don't know more about financing than everybody on your podcast, right? Or all your audience out here, right? So understand, I teach people that they're like, oh, Eddie, I really don't know this. I'm like, okay, that's fine, right? You can rent me, and I've already run all the experiments. And I will tell you the most likely things that a person carrying seller financing will agree to. Like how do you ask the right question to even see if they're willing to seller finance? Would that be a good place to start?
That'd be a great place.
So what you have to do that, if you think you're your real estate investor might get a little intimidated. Think about the property seller. So how do you say something so simple that everybody totally, instantly gets what you're saying? You got to go pick something that everybody with a driver's license essentially is aware of. And so you go pick another industry where they have sold something at retail and they collect their payments in the future. And the most common thing is going to be furniture companies. And you might say it like this, Brian. You might say, it doesn't sound like your property is going to qualify for this program. That sound like straight out of Real Estate Sales Academy? Because that's exactly where it is. Because I collaborate with Jerry Green on this, right?
Yeah.
And so there's a lot of science that goes into why they say that. There's another program that we might talk about that I think your property might qualify for that would allow you to get more of what you want. Now, what do you think when you say that? What do you think they're going to say? I'm not interested in hearing about that?
No, they're going to want to know about it.
So then I'm going to say, right, it sounds like to me price is really your biggest thing. And aren't most property sellers going to agree to that? And when they do, you say, well, there's a smart way to do this. And that is you can make the same smart decision that these furniture companies make. They know they can sell the furniture at retail and they take their price over time. And if you could help me with that, then I think it could be a win-win for both sides. I want them mentally deciding that they're going to do it before they even know how they're going to get paid.
Yeah.
Does that make sense?
That's tough too. Yeah, because it's a whole process you have to do to get that to happen.
Well, you know the deal, right? You know, you got to get the customer's permission to delve off into their finances, right? So many times people delve off into their financing and they haven't really positioned the customer to get their approval that I'm trying to help you. I'm going to need to know that in order to help you. And then the customer doesn't tell them the truth. And they're like, well, man, the customer lied to me. Well, you didn't give them the truth serum.
Yeah.
You got to give them the truth serum.
Right. Yeah. Yeah, because they're always defensive. Yeah, if you don't do it right, they're defensive. They're lying. They're not telling you. They got their guard up.
Exactly.
Cool. So you help people do this. So if someone wants to have you help them out and learn this, what's the best way to get in touch with you, and what all can you help people with?
Well, the best way for somebody to start is that we've developed a master class, and it's a couple of hours. You can go on the internet and you can buy it for $100. They can go through you, and I'll let them come for free.
Right.
And it's going to be noteschool.com/Driscoll. Right?
Okay.
Pretty easy. And this masterclass is where we go through the process and we show you some case studies, some examples, and we show you these decision tree paths, and we show you a blueprint, and we show you some of the things that I've alluded to. And all of a sudden, what I've discovered is like, boom, all the fog's lifted away. And now somebody's like, okay, I can see that I probably have customers in my trash can already, like from the last 2 weeks, that if I would have asked them the right questions, I could have opened up a whole nother lane to take them down. Because that's the key to this business right now. You cannot be a one-trick pony. Did you know that when you look at statistics for investors, and most wholesalers were flipping to investors, they weren't flipping to consumers. You agree with that?
Right, yeah.
Right? So a year ago, the hedge funds were the cat's meow. They were paying up to 110% of market value. Now, you may say, well, some guy that's a wholesaler might say, well, I wasn't flipping to a New York hedge fund. I know you were flipping to somebody that was flipping to the hedge fund. But that deal was ending up in the hedge fund's inventory. Am I right? Like, big percentage of the time.
A lot, a lot of.
In the second path that a deal went down was they were selling to somebody that was kind of like a new wannabe landlord, an HGTV dreamer, so to speak, right? So that's where most wholesalers' deals were landing. Last year, at the last quarter of last year, that investor impact was up 150%. I just did a statistical thing in Note School TV about this yesterday, like literally, okay? This year, it's dropped back not just to zero, but it's now 30% below. We have 80% swing in investor activity. And people want to know what's happened to the wholesale business. Well, guess what? The guys that want to buy from you don't want to buy it near the same price anymore. Because they can't. It's not that they're being ugly. They can't. They can't go pay more than twice the interest rate, or a hedge fund can't go buy an investment at such a low yield anymore because the math won't work. So they have to lower their price. And so that means that a lot more customers are frustrated about the price gap. Is that true?
100%. Yeah, it's a big problem.
The number one way you can fix the price gap is creative financing.
Right. Yeah, because you can afford to pay more because of how you're paying it.
Exactly.
Yeah, that's interesting, especially in this market now, because who knows what's going to happen.
Well, I have a friend that manages a hedge fund entity. He has $30 billion under management. As he likes to say, we make billion-dollar bets. They spend almost $2 million a year with analytics firm to determine future interest rates, trends in real estate values, all that kind of stuff. So I'm very fortunate. I get to have a seat at the table with him and discuss where the market's going. I found out it's way better to get that information than to go on Facebook and try to get it.
100%.
You get what I'm saying?
Oh, yeah.
And he, pretty much the trend that we're in is going to continue. They're not saying that rates are going to go become 14%, but we're not fixing to see some big drop in rates and all this, interest rate increase was temporary. That's probably not a truth. So rates are here in the range that they're in. They're probably here to stay for a while. And we're going to see a slide in real estate values. I mean, we know everybody from Denver West has already experienced it in a pretty significant degree. So people are like, and you're in Pittsburgh and I'm in Dallas. People say, well, that hasn't affected us. Well, let me just tell you something. If you think real estate trends don't swing west to east, you need to go read a history book. And so this hedge fund who makes these billion-dollar bets, they have to have a good scientific data of to where the market's going. And so I would say that for those reasons, that's why I don't see the hedge funds jumping back into the game and all of a sudden like, oh, well, we took out for a while, but we're back in again. I don't think that's going to be a truth. I don't mean there's not Wall Street money buying properties. They're not buying properties at the price they were paying, right? That's the key. Wall Street money looks like everybody else's money, right?
Right.
Wall Street decided they were going to be really aggressive and go essentially overpay. And they had a theory as to why they were doing it. They were securitizing rentals like they were securitizing mortgages back before 2008. That was their gimmick. And so when they could do that, that really changed, what they could pay for properties. But once again, when rates start going up, they have to plug a different number in their spreadsheet, right? Which means the price goes down.
Right.
So those are the scientific reasons why we are where we are. And I would say that there's one kind of like final, here's the top and on top of it. I'm in masterminds with you and a bunch of other real estate investors. Top 500 guys in the United States, probably 80% of them are one of the masterminds that I'm involved in. And I've gotten to do a lot of speaking and training at many of them, right? Most of them. I don't know a single real estate investor that wouldn't be doing creative financing today unless they didn't know how. The only reason they wouldn't be doing it today is they didn't know how to do it. Everybody else would be doing it because it would be completely illogical if you weren't doing it.
Right. Yeah, 100%. And that's right, too. A lot of people, they just don't know. And that's where you can come in.
Well, once again, I used an expression earlier. You're renting my experience. This is my 42nd year in the business.
It's a long time.
Done 50,000 deals. So, and I built a school around that. And you say, well, Eddie, why did you build a school? Because I can do a lot of business with people once I teach them how to do business. It's very difficult for me to go do a lot of business with somebody when they don't know what the recipe is. And they cook the wrong thing.
Yeah, 100%. So, hey, tell everyone again how they can reach out to you.
Okay, it's noteschool.com/Driscoll, your last name.
Nice and easy.
Nice and easy.
Yeah, cool. We're about out of time here, but yeah, we appreciate you coming on. Everyone listening, reach out to Eddie. Go check out those courses and learn some seller financing and see if it's a fit for you. Hey, thanks for coming on, Eddie. We appreciate you.
Great to see you. Thank you.
Thanks, man. Hey, everyone, thanks for listening. Get out there, crush it, close some deals.